What's up everyone? Certainly not growth stocks. It's Griffin here, and if you invest in the stock market at all, chances are that you've logged into your account recently and it looks a little something like this. We're pretty much seeing a sea of red across all growth specific stocks that have had a significant run up over the past year or so. Interestingly though, although many companies that operate in fintech, big tech, healthcare, gaming, and other growth oriented industries, their stocks have been selling off consistently over the past couple of months, we're still seeing large market indexes trading near all-time highs like the S&P 500, the Nasdaq, as well as the Dow Jones index, and we're in no way seeing a large correction at this point, right? If we take a look at the chart of the S&P 500 here, we're seeing that it is down around 3.5% as it stands over the weekend here, and the Dow Jones Industrial is down around 6%, but definitely nothing too significant than just a healthy pullback for now from all-time highs. Let's also not forget the fact that the S&P 500's underlying forward price to earnings ratio is still among the highest it's been since the early 2000s. So considering other macroeconomic elements coming into play right now that are swaying the markets, we could definitely say that we're seeing a somewhat fragile and uncertain market as it stands right now. With that said, when it comes to broad market indexes like the S&P 500, the Nasdaq 100, and then some other broad market indexes that track small and mid cap stocks, short-term price movements, both positive and negative, are really of zero importance to me, as I always maintain a longer term outlook for these types of positions. Every month I buy into funds like these regardless of what new virus variant hits the news, what Jerome Powell is saying, or how much a loaf of bread costs at the grocery store. These are exchange traded funds that I consistently buy into for a long-term hold. Really, this is what I've been doing since the end of 2016, and despite the market seeing significant pullbacks and expansions over this period of time, dollar cost averaging into the market has always been a winning strategy for me. This is also the reason why, even though we speak about individual stocks all the time on the channel, I believe that for the average retail investor, holding a healthy portion of broad market exchange traded funds in a portfolio makes sense, as acting as a foundational layer for consistent growth and appreciation of your portfolio over time. I personally even hold up to sometimes 50% of my entire portfolio allocation towards these broad market index funds, as therefore I'm able to go out and take more risky positions on individual stocks I think might beat out the market, and some are going to perform poorly, but that's something that I'm okay with because I know I have a strong foundation to my portfolio. All of this to say, as it stands right now, the broad market is still in a position of a small healthy pullback, but that's not really the case for many growth positions that are down in the trenches, mainly upon the news of inflation right now, but then also as a result of this, increased interest rates that are expected to take place in the first quarter or first half of 2022. For example, just to name a few, PayPal is down around 40% from all-time highs, TDOC is down a whopping 68%, Facebook down nearly 20%, Trulieve is down around 48%, Corsair, don't even get me started, down around 50% or 54% I should say, from all-time highs. So of course every company is going to have distinct reasons as to why their stock is selling off, but in general, why are many growth stocks selling off continuously to the point where if this was the broad market, it would be in a bear market right now? Many of these stocks are down more than that 30% bear market territory. First of all, stocks in general tend to perform poorly in an environment of higher interest rates, period. But this is even more true for growth stocks for a couple of reasons. First of all, the cost of borrowing increases when the interest rate increases. So therefore, many growth stocks actually utilize significant amounts of debt in order to finance the further growth of their operations, their finances, etc. So when interest rates go up, this essentially means that it's more expensive for these companies to borrow funds, and therefore it makes them less profitable. The second main reason is that growth stocks are often valued in terms of future growth expectations for their top and bottom line. So when the cost of borrowing goes up, this essentially has an impact on their future discounted cash flows, and without getting into detail about that, essentially it just makes them less attractive for the future. And the third main reason is that when interest rates rise, this means that interest incurred on cash savings doing literally nothing also increases, making it more attractive, and growth stocks are usually purchased in a portfolio in order to try and create higher returns than the market. So making really easy money on cash is more attractive when interest rates rise, and therefore usually this has a negative impact also on growth stocks. All right, so with all that said, let's now speak about some of these stocks that I've been buying into further over the past week or so as their price point has been moving lower and lower. And moving into 2022 here with, as I just said, interest rates expected to rise, I've also been looking at increasing both my fixed income as well as some dividend positions in my overall portfolio. Let's start with Canadian positions here, and also keep in mind that since we're going to be covering quite a few of them, I'm not going to go into a full in-depth analysis of each one. We're kind of going to quickly go over each one of these stocks. So the first company here is TELUS, ticker symbol T.TO on the TSX. It's a large telecommunications company that operates across Canada, and they also have subsidiaries like Koodo Mobile. Now, TELUS is a Canadian dividend stock that I've been holding for a while now. I speak about it recurringly on the channel as it's a company that I just consistently buy into every couple of weeks or months when I see small dips in share price. This stock actually isn't really in a large dip as of right now, but this is again one of my go-to Canadian dividend stocks that I consistently buy into whenever I can. So since I've been adding to my position lately, I thought I would mention it in today's video. And recently it was in a position where it had dipped down by around 8% from September to October. I was buying some shares during that dip, and even right now though, over the past week, I've also continued purchasing more because I really just see this as a longer term growth play, and their dividend is very attractive. TELUS really is one of these Canadian companies I see as a long-term play, and their dividend yield right now is very attractive at 4.4%, even considering the fact that the market price point has bounced back from that low that it saw last month in October. What's more is that the company also has a dividend growth streak of 17 consecutive years, which is fantastic. Finally, I don't think TELUS is a company that's going to be all too impacted by the increased interest rates that we're expected to see next year, as this is a company that has extremely consistent and resilient financials as a result of their solid customer base across Canada. All right, the second stock that I've been buying into further this past week, and I still have an eye on it as I'm going to continue buying more as I see this stock continuing to see a reversal. It is GoEasy, ticker symbol GSY.TO on the TSX. As it stands right now, GSY stock is down roughly 20% from its all-time highs, which I was happy to see because it's a stock that has done very well for me over the past year, and they've continued to post fantastic financial growth quarter over quarter and year over year. So seeing a stock as solid as this one continue to sell off right now is something that I'm happy to see, as I'm going to continue buying more shares for, again, a longer term hold. Most of all the positions I speak about on the channel, I'm looking at for minimum a 1-year hold. That's something that a lot of people need to realize and kind of remind themselves, because not every position is going to perform extremely well in the short term, especially when you're looking at stuff from less than a 1-year lens. This is a company that's extremely profitable though, and they have a very high return on equity at 40% with consistent and steady financial growth, which is what I like to see for a long-term position. The company also pays out a slight dividend, even though quite a low yield at around 1.5%, but it's been extremely consistent and grows each and every year. For now, analysts also have estimates for this stock at around $230 per share, which would represent some nice upside over the next 12 months. However, again, also analyst estimates are never something that are concrete and set in stone. This is something we've seen over and over again. In fact, my video that we just looked at, 2 days ago, where we looked over DocuSign, the stock dropped by like 40% in one single day. A couple days prior to that, analyst estimates had it for like $100 more than what it was trading at over the next 12 months. And then upon that news, analysts will go and change their ratings and estimates. So that's always just something to keep in mind, that Wall Street is consistently changing their estimates as time goes on and as new information is being delivered to the markets, just like myself. The third Canadian stock that I bought more of during, in this case, a relatively significant dip for this company is Capital Power, ticker symbol CPX on the TSX, which is definitely more of a dividend stock with their nice current dividend yield of right around 5.7%. Now, Capital Power is a stock that I have spoken about previously on the channel. It's been a while. However, this is a dividend stock that I consistently also buy into every couple of months, because it's a company that despite the fact that their top line has been stalling in recent quarters, they have significant cash flows, and their dividend is also extremely nice for any dividend portfolio. For example, what I was just speaking about here, on a quarterly basis, when you look at their financials, in the past 2 quarters, their top and bottom line have been stalling. However, on an annual basis, their top line has been increasing relatively consistently since 2017. That being said though, this is a company that has very high cash flows relative to their top line. And more recently, from a business standpoint, CPX has also announced that they're continuing to expand their renewable energy portfolio in 2022 with the acquisition of a solar development site in the US and a couple handful of other projects that should also continue to increase their revenues over the coming years. For the company's 2022 outlook, they have also increased their adjusted funds from operations guidance to $630 million, with annual dividend growth guidance of 5% per year from 2022 to 2025, with an adjusted funds from operation payout ratio between 45 and 55%, which is good to see. CPX is a company like, for example, Enbridge, where if you take a look at their dividend relative to their net income, the dividend payout ratio is significantly higher than what a typical dividend stock would be tolerable. For example, that 50% or lower dividend payout ratio target estimate. However, in this case, when you look at it from an adjusted funds from operations standpoint, we're seeing something that's a bit more healthy at around 45 to 55% target. That is something that for a fund or a utility company that has higher cash flows is what you're after. So yeah, with an energy company like this one, it's really those higher cash flows as well as the funds from operations that you're after for that maintaining of a dividend distribution over time. So to wrap up CPX here, if you're looking for some Canadian dividend stocks to increase your portfolio income over the coming year, this could be an interesting company to look into. All right, the next stock we're going to be taking a look at here is Lightspeed, ticker symbol LSPD, both on the TSX and the NYSE. Now here's the thing about Lightspeed, I'm not really going to get into it since we just covered it in a video I posted on Saturday. Check it out here if you haven't already. The problem with Lightspeed is that right now, even despite the fact that it's down over 60% from its all-time highs in really a small time frame here, around 1 month, the issue here is that Lightspeed is currently in a position where it has allegations towards it that it boosted its pre-IPO numbers. And this has investors extremely worried and bearish about the future of the company as it stands right now. And this is the last thing that you want when you're investing in especially a growth stock. For example, take a look at Alibaba. Anything political that's coming into play or legal that's coming into play just provides so much volatility to the stock and its price movements in the short term. So until we see some concrete footing and a ground floor for that stock with some reversal, this is basically just like catching a falling knife at this point. So I have not been buying more shares. So many people have been asking me, that's pretty much it right now. But if I do start buying more shares in the near future, I will make a video about it. And then finally, in the Canadian markets, this is not an equity that's down significantly, but I've also picked up some shares of a fixed income fund, being the Pimco Tactical Income Opportunities Fund, ticker symbol PTO.UN, which is a fund that invests in income generating positions across multiple global fixed income sectors, including residential and commercial mortgage-backed securities, high yield corporate bonds, and so forth. It's important to note though that this is an actively managed fund rather than say a passively managed exchange trade fund. So for this reason, the management expense ratio is quite a bit higher, and it's a relatively new fund, so the actual final MER is not yet set. However, it has a management fee of 1.2%, which is very high. This is usually something I always recommend staying far away from. However, in this case, it is a fund where I'm looking for more of that stability in the actual capital itself, but with a nice dividend yield on a monthly basis moving into 2022, considering the fact that most of my portfolio is high growth oriented for that longer term play. So this just brings some stability to my portfolio. So that's the idea behind this fund. And right now it has a very nice dividend yield of 5.9% paid out monthly. And remember, this is a fixed income position rather than a yield or a regular dividend distribution from an equity, a stock. With all this in mind though, this is not necessarily a fund that I would recommend for everyone. This is just something that personally, considering the stability of this type of fund, is something that I'm looking to include in my portfolio, and I've only purchased a really small portion of it for that monthly dividend income. With that said, if you compare the PTO fund to, for example, a Vanguard bond index fund that is passively managed, the management expense ratio is significantly lower. So on the VGV ETF, which is the Canadian Government Bond Index ETF offered by Vanguard, the management expense ratio is only 0.2%, so significantly less. However, the 12-month yield is also significantly lower at 2.44%, which when we take a look at that difference between the MER versus the yield on both of these funds, 12-month yield on the PTO fund actually comes out higher than it would be on, for example, the VGV fund. And then also considering the fact that, let's say year to date, the VGV fund is down around 5% as it stands right now. It's also just great to have some fixed income exposure in a portfolio, even if your portfolio is high growth oriented like mine is for the long term. All right, so that's around 5 Canadian positions I've been adding to my portfolio. Make sure to comment comment down below which Canadian positions you've been adding to your stock portfolio now and moving into 2022 and your logic behind each one. I'd love to know. Also, at this point, we're around midway through the video, so make sure to smash the like button if you're enjoying the content, and also subscribe, hit that bell button to be notified of new and upcoming content. I'd also encourage you to check out the links down below to resources I use and recommend. You can get some free money for opening up brokerage and savings account. And then also a couple weeks back, I made a video speaking about a stock market research platform and stock market portfolio tracker that I've been working on for the past several months. Now, upon that first release, a lot of the client feedback was the fact that even to get access to the 14-day trial, you had to put in a credit card. So we've changed that. You can go in, do a 14-day trial, try it out, see if you like it or not. You don't need to put a credit card or anything in. And yeah, make sure to check that out down in the description. It is called Bull Runs, and it is completely free use on that 14-day trial. Okay, now of course though, as a stock market investor here, yes, I'm purchasing some Canadian stocks, but I've also picked up some American positions over the past week or so. So let's speak about those right now. Now, first of all, considering the stocks we just spoke about in the past video on Saturday, there's 3 of them been purchasing shares or will be purchasing shares of next week. So those are DocuSign, PayPal, as well as Celsius Holdings. Quickly to cover the first one being PayPal, this is a stock that I just really don't think is being treated fairly in the market considering their business and financial growth. The stock right now is down more than 40%, bringing their relative price to earnings ratio to a level that it saw last year, since the underlying growth has been stellar. To me, PayPal stock being down so much just really doesn't make too much sense considering the company's business and financial growth. They've been seeing consistent increases in top line and bottom line figures over the past couple of years, and they've also been seeing consistent growth in their user base. Not to mention the fact that for 2022, they've recently just partnered with Amazon to have Venmo being one of the payment options when you're checking out on Amazon. So I think that's going to be a huge win for PayPal. And overall, with the stock being down 40%, I picked up some shares last week, and I'm going to continue picking up some shares if we continue seeing the stock tumbling down. That second one here being DocuSign that we just mentioned. Well, DocuSign is a company that's still growing at a very nice pace. So year over year, we saw the recently reported quarter growing by around 40%. And now the guidance for Q4 is growth of around 30%. The reason why it sold off 45% though in one single trading period is really just because the CEO mentioned the fact that we're seeing some slow or cool down really of that top line growth for the company. Now, this is definitely to be expected considering the fact that DocuSign is a company that saw huge tailwinds from the pandemic, and they were able to ride that momentum as the work from home economy was booming and there was an increased need for at a distance document signing. With that said though, DocuSign's underlying net income growth though is expected to grow by around 100% per year over the next couple of years, reaching profitability near the end of 2022, and their top line is also expected to continue increasing even though at a lower pace than what was previously anticipated. So at the price point right now at around $140 per share, I'm just going to pick up a couple shares for some growth over the next year or two. Now, in the previous video though that I posted on Saturday, a couple people said, wouldn't this be extremely risky? Yeah, it is definitely more of a risky position, and it's not something that I would recommend for someone who isn't comfortable with potential volatility coming from this type of position over the next year. I would only consider buying stocks of DocuSign if you're okay with holding on to shares for at least a 1-year period. All right, moving into that third American stock here, we have Facebook, ticker symbol SB, or should I say now it is Meta Platforms. Now, this is also a stock that I recently spoke about in the Meta Stocks to Watch video. I would highly recommend you check that one out if you haven't already, because we explain what the metaverse is, the opportunities that the metaverse can give for the world really, but then also for investors, and then from there some stocks to keep an eye on in a metaverse watch list. And Meta, of course, Meta Platforms is one of these top companies. I've personally been bullish on Facebook for multiple years now. They're an extremely profitable company, and despite the fact that they're getting a lot of backlash from the media as well as political flashback really, and then also the fact that they have rebranded to Meta Platforms, have kind of been like a laughing stock really in the world of investing. Well, this is still an extremely solid company, and their stock right now is down roughly 20%. So I've picked up some more shares of Facebook. Meta Platforms, I need to get used to saying that, but for a multi-year hold, as I just think think this is a company that, despite all of the negative feedback that they're getting in the media and so forth, well, this is a company that over the next 10 years is just going to continue thriving and gaining dominance in the advertising space, but then also the opportunities that the metaverse is going to offer them. Otherwise, I've also continued bolstering my positions in certain broad market index funds, like just a typical S&P 500 index fund, NASDAQ 100 index fund, and then some other mid and small cap ETFs that cover a broad mix of those small and mid cap stocks in the American markets. That pretty well wraps up why we're seeing many growth stocks tumble down over the past couple of weeks, as well as in some cases past couple of months. I really hope you enjoyed the video. If you did, make sure to smash the like button. And of course, well, a video like this going over multiple different positions that I'm buying over the past week to 2 weeks could be extremely long. So I tried to summarize as much as possible, but let me know down in the comments if there's any of these stocks you'd like me to expand further on in an upcoming video. And then, considering the fact that it takes a lot of time to put together YouTube videos, writing them out, filming them, editing them, and then posting over to my YouTube channel, make sure to follow me over on Instagram at Griffin Milks, where I post more at daily posts, as well as sometimes some stocks that I'm buying on a more quick manner. So also don't forget to check out all the links down below in the description to resources I use and recommend, and you can get some free money for signing up to brokerage accounts as well as some savings accounts. Down there you can also find links to bull runs I spoke about earlier. You can get full access to the entire functionality of the stock research platform, as well as the stock market, as well as the portfolio tracker, and you don't need a credit card or anything to get access to that full functionality. Also, don't forget to check out the full stock market investing course. I'll just leave a link down in the description. And on that note, thanks a lot for watching today's video, and I will see you in the next one.